Okay, so this is in the course materials, exam study info, exam 3 study guide. And it's really just an outline. And what I did was I went through the questions on the exam and highlighted all of the topics that are covered. Now, in some cases, I put a little more on there. Let's just say, for example, there's a question on common stock and it's asked about issued. So I put authorized, outstanding, so that you would know just in general about looking at those dates. And the way that I have this set up is by chapter. And what I did with the morning class, and I'll do with you guys, is just to kind of walk through this. And if you have questions, you can either type them into the chat or pop on the voice and ask me. So chapter 6 is about non-current assets. And there's a few things there. There's capitalization, depreciation, and then looking at some of the expenses that surround them. So first thing, what are long-term assets? You have land, tangible property, plant and equipment, intangible assets, copyright, patent, trademarks. And then what do you need to know about those? Recording in the accounting records, capitalization, which would mean creating the asset. What value do you put in the books for that asset? Expense, for the most part, this is depreciation or amortization. And then cash flows, out for the purchase or in for the sale. You have gain or loss on sale of non-current assets. And so that gain or loss would be your proceeds minus your book value. You have, go ahead, just got a question here in the chat. What's the difference between depreciation and amortization? Depreciation is for tangible assets and intangible has amortization. So good question. And I will post this document as kind of a second one in with those other documents. And actually, I should say it's the third one. I'll talk a little bit more about the second one in a minute. All right. Depreciation, calculation of, straight line, units of activity, multiple years of depreciation. So I could ask about what is the second or what is the third. Book value, you have your historical cost, accumulated depreciation. And then even though we covered this a lot in 10, there are some questions in each of the chapters that just kind of hits on some of the important ratios for those chapters. So what is the return on assets? What is the asset turnover? And any ratios that we ask about on the test will give you the ratio in the question, just the same, so you won't have to memorize it. So I just had a question pop up as I was saying that. You won't need to know any of the formulas, just like in the last test. If it asks a question on the ratio, it'll have it in parentheses in the question itself. All right. So any questions on chapter 6 coming from your homework, classwork, just in general? Now, one of the things that another faculty member did was share with me their version of the study guide, and it's a little bit more definitional in that it includes them. So what I've done is I've also provided you with this set of notes as well. So if you prefer to do reading rather than kind of filling in the blank on your own, this set of notes will also be very helpful for you. And so it has some of the formulas in there, some of the calculations. This is all in Blackboard under course materials and then exam study information. So I figured another faculty member shared them with me. Might as well put out there as many study guides for you as possible. Mine is more tailored to the questions that I know are on the exam. So you have, you know, kind of an idea. There's no topics that aren't covered there, but it requires you to do a little digging and filling in the blanks to make sure that you have knowledge of the items. And this has a little bit less about the specific topics, but more in terms of definitions and some of the formulas in place. Okay. So if there's no questions on chapter 6, I'm going to move to chapter 7. Okay. So in chapter 7, we're covering liabilities. Now I kind of skipped over the basic current liabilities, and we're talking about some of the meatier aspects of it: notes and bonds payable, recording the accounting records, borrowing, payment of principal, payment of interest, calculation of interest expense versus principal. So if it says they paid $1,000 on their mortgage, there were a couple questions that asked what was interest and what was principal in our class notes. Current versus non-current. So current's going to be paid within 1 year, non-current going to be paid beyond a year. Now remember, non-current that is going to be refinanced coming up within the next year still is classified as non-current. Unearned revenue, remember, is a liability. It's a current liability in most cases. And you want to record it in the accounting records. So keep in mind, like supplies, only on the opposite side, when you get money or deposit from a customer, you haven't performed that service yet, so you're obligated to do so in the future. Once you've earned it, then you reduce your liability and report your earnings. And then if you haven't completed it, you'll have a balance at the year end. A few of the ratios: current ratio, debt to equity, debt to assets. Now, one of the things that I'll point out is if you look at the other document in chapter 7, they have liabilities listed, and you don't need to know anything about contingent liabilities, and you don't need to know about leases except for what is an operating lease, what is a capital lease. I don't have any questions on the exam related to these, and you don't have to worry about off-balance sheet financing. So this other faculty member covered that in their class, so they have it on their test. I do not have it on mine. All right, so back to our study guide. Have the list here: notes and bonds payable, calculation of interest expense, unearned revenue, and analysis of debt. Any questions about the topics in chapter 7? Any of the problems from homework or classwork that I can answer any questions for you about? So I got a question, but it's on chapter 8. So I'm going to hold off for 1 second on that. Okay, so I have a question. Somebody asked, how do I record unearned revenue on the accounting statement? So I'm just going to go down and I'll do an example here. So give me a second just to type it up. Okay, so this is an example. You won't find it anywhere. I just kind of pulled it out of my head here. Did one similar for the class earlier this morning. So take a second to read that. Okay, so the first part, how is this recorded in the accounting records? So we record the cash of 2.1 million, and then under the liabilities, we record unearned revenue of 2.1 million. All right, so that's all we would record for that first entry. B, the adjusting entry at year end, the company has earned a third of the revenue. So 2.1 million divided by 3 is 700,000. So we would record unearned revenue, a decrease of 700,000 and revenue of 700,000. C, at year end, remaining balance would be I have to slide the screen up a little bit, forgive me. 2.1 million minus the 700,000. So this would be 2020. And so we'd have 1.4 million, and 2021 unearned revenue 1.4 million minus the 700,000 equals 700,000. Okay. Any questions? Okay. If there's no questions, I'm going to move on to chapter 8. So in chapter 8, it's about stockholders' equity. And so you have to know how to record transactions in the accounting records. So remember, the things that we record in stockholders' equity would fall under 2 categories. You have retained earnings and contributed capital. And those are our 2 main categories. And in retained earnings, we record revenue, expense, and dividends. And so just some information about dividends. The date of declaration is the date that the board says we are going to pay a dividend. And so that becomes a liability. The record date is who owns this share on the date of record is going to get the dividend. And then the payment date of the dividend. And so you might have to calculate the payment for preferred and common shares. So I had a question, and the question said, what's a declared dividend versus a regular one? So there's not really a difference there. It's just once a dividend is declared, it becomes a liability. Generally speaking, if I had to come up with a difference between the two, it's just timing. Okay. The record date, someone asked, can I go over what the record date is? And the record date is the date that the company records ownership of the stock to pay the dividend to that person or entity. So there is some time between the time that they declare a dividend where somebody may sell the stock or buy the stock, and during that time they're not entitled to that dividend until it gets to the record date. Contributed capital is the other part of retained earnings, and this is what ownership has put into the company. So you have common stock, preferred stock, treasury stock, and additional paid in capital. And so I kind of break out what are the parts of common stock. So you have how many shares are authorized, how many shares are issued, how many shares are outstanding. And then if you have par value, non-par value, or no par value, additional paid in capital, and then calculation of dividends. And that's no different than the calculation of dividends up above. I just put it in retained earnings to remind you that dividends are deducted from retained earnings. Preferred stock has a stated value and a stated rate. Some might call those face value or face rate. and you have to calculate dividends, principal times rate times time. So use that stated value times the stated rate times the time. Okay. And then generally you have to multiply that whole thing by the number of shares. Dividend priority just explains that if the company declares dividends and it has preferred stock owners have the first right to dividends. Treasury stock, it's its own stock purchased back by the company, but not retired. So cost is the price the company paid for the stock. And then the sale, it would come back and reduce the treasury stock amount, and any additional amount would be recorded as paid in capital. So any questions on chapter 8? I'm going to go over just quickly and walk through. So again, a little bit more kind of going back into the types of businesses, some of the advantages, common versus preferred. So it answers some of the outline questions that I have. Any difference between the purchase price and the resale of treasury stock is not treated as a gain. All right, which I noted there. Don't worry too much about the stock dividends. You should know that they can issue stock splits and stock dividends, but you won't have to calculate it. Okay. So now dropping back to our handout study guide outline, we move to chapter 9. So we have the cash flow statement, and the important things here is to know the 3 sections. So you have operating activities, investing activities, and financing activities. Within operating, you have 2 methods. And one would be the indirect method. And this indirect method starts with net income or net earnings. So you know, if you see cash flows and the statement starts out with start with net income or net earnings, then you know it's the indirect method. Versus the direct, which is where they report cash received from customers, and how they do that is they reconcile the sales and accounts receivable. Cash paid to suppliers, cash paid for supplies, and cash paid for other vendors. Okay, so that's the operating section. We went through a couple of these questions for chapter 9, actually about 6 of them, and then we also had some on your coursework. Now, keep in mind the treatment of interest expense and financial investment income and dividends. So those are the things that we receive. It's already part of net income, so they're included already. So they're part of the operating section. Investing activities only has 2 broad categories, which can be split up into 4. So you have your cash for purchase of non-current assets, or cash received from sale of non-current assets. You have your cash for purchase of financial investments or your cash for sale of financial investments. And then your financing activities. So these would be transactions with owners. And so dividends are included here, but only if they're paid in cash. Right? Non-cash dividends or dividends that are declared but not paid are not included. You also have the sale of purchase of common stock, treasury stock, preferred stock, and then principal debt transactions with lien holders. So this would be the payment of principal. This reduces the amount of money that you owe, and new borrowing. So when you borrow more cash. And so those are only the transactions associated with the debt, not the interest expense. That's up in operating. And this is only the company's payment of dividends. Remember, in the notes, you report non-cash transactions. So if you signed a mortgage for a building, then you would report that. Or if you exchange stock to buy a business, then you would report that as a non-cash transaction as well. All right, so that's kind of the outline version of it. And then I'm going to share the other document with you. And so gives you kind of a similar layout. Their example will be a little bit different, but you can see that they're pulled from the text. Keep in mind that they posted one with an error. But for the most part with this, you're going to be using multiple choice questions, so you won't have these long questions. Okay, and you don't have to worry about free cash flows. Okay. So the question I got was, are you going to have to calculate the indirect method? And it is quite possible that you will have to calculate the portion of the indirect method. So they'll give you some accounts and ask you, what are the cash flows that would be reported in indirect? We went over one of those examples in class. And so you can take a look at that to guide you through it. But you're not going to have to prepare like a full section. Because these are multiple choice questions on the test. All right, so that's what I have prepared for today. If you have any questions, I'll be happy to help. Now, again, this video and the handout will be put up in Blackboard. And if you don't have any other questions, you are free to go. Have a great day. You're welcome.